As if things can't get any stranger, in this episode we're going to talk about selling the rumor and buying the news. What? That's usually the opposite of what you do. So stick with me as we dive into the details. My name is Brian Cannon and welcome to Markets in 5. So we just had the inflation numbers hit for November, and we've got an annualized 6.8% annualized inflation rate as of November. So it's kind of getting out of control. So the Fed, realizing this, has got to make decisions, and the only real way they can control inflation is to begin to raise the federal funds rate. So that's the overnight lending and borrowing rates that banks use. And essentially, when you raise those rates, it strips liquidity out of the market, it makes lending more expensive, and essentially starts to slow down growth. So that usually is a turning sign for the market. And but again, it could be a long slope to get there, but it is certainly something we're watching very closely. But you know, it's interesting. The Fed came out and said, "Oh, we're not going to raise rates, but we're going to start more aggressively tapering our bond purchases." And so they didn't even talk about selling bonds at this point, just reducing the speed at which they're buying bonds. And they said that they're expecting up to 3 rate hikes next year. So the market is a futures marketplace. So, but clearly, upon that news, which we all were expecting, it was more of a sell the rumor and buy the news. It was kind of the opposite of what generally you would think about. And so it's just an interesting market right now. Lots of volatility, lots of chop. But the futures are up today on Thursday, and so we'll see if if we get that break. And but almost, from a channel perspective, we always talk about the channel in this upper channel. So now that we've kind of broken down, it's almost like music, right? So you've got this upper line. There we go. You've got this upper line, upper channel here, and now we've dropped down and found kind of the lower band of the musical notes. So it's interesting. So now it appears that we've got some support here, and our resistance is now the lower line of the upper chords. So anyway, we've got a little bit of a negative divergence right here. We've got RSI heading down. However, we've got the market, going sideways and potentially heading up after today. So just watching that closely. But the positive note is the histogram on the MACD is heading up. We barely got into negative territory, but it turned around. So all in all, this looks okay to me. There's nothing that screams, any sort of, sirens at this point. Now, I put this chart together for a couple of articles I've done recently in CNBC and CBS discussing inflation. And we are only in the 6th period of inflation, really in our modern day history since the 1920s. And essentially, if you look at every single period of history where we had inflation, and look at it, the average is about 1 to 2 years in duration. So we did have a long bout of inflation from the kind of the early 70s to the early 80s, and that correlated with stagflation, and that's a real problem for the government to handle, because essentially what they do to try to fix one thing is the opposite of what so if you've got growth slowing, but you've got inflation rising, but you're going to cut the rates to control inflation, but then you're going to further hamper growth. So stagflation is something that we do not want to see in the marketplace. So if we have persistent inflation that lasts, but we have stagflation or stagnation and slow growth that starts to come around, that could be a real problem for the market and really send us into a secular bear market for a long period of time. So we're watching that very closely. The last chart here is the 2-year Treasury. You've seen a sharp rise off the bottom this year, and that essentially just has to deal with the inflation. As inflation rises, the 2-year rises, and so it's just we've had a little breakout here. And so we're going to continue to watch these numbers, but I know the Fed's watching them, and I know that's how they're basing their decisions. So as we get close to wrapping this year up, I think you'll start to see continued volatility in the market. I think you've got a lot of portfolio managers that are repositioning. You've got a lot of investors taking profits and cutting losses and doing tax loss harvesting. So I think we'll continue to have volatility, but if you have any questions, give me a shout, and I'll see you on the next Markets in 5.